How is the potential relocation of Visa to London's Canary Wharf reshaping the commercial real estate landscape in the United Kingdom? And what strategic opportunities does it present for investors? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoan. Let's get right to it. London's commercial real estate market is experiencing a renaissance, driven in part by the potential relocation of Visa to Canary Wharf. This move signals a renewed confidence in the United Kingdom's post-Brexit financial ecosystem amid ongoing regulatory reforms and the rise of hybrid work trends. As the United Kingdom navigates this complex economic landscape, prime office assets in London's core financial districts are emerging as strategic investment opportunities. Canary Wharf, once the epicenter of London's post-Brexit corporate exodus, now finds itself at a crossroads. As of the first quarter of 2025, the Docklands core area reported an 18.6% vacancy rate, a stark increase from 3.5% in 2017. Major firms like HSBC and Deutsche Bank have relocated to the City of London, while hybrid work models have reduced demand for traditional office footprints. Yet, Canary Wharf's strategic advantages, such as superior transport links, proximity to the city, and a culture of innovation, remain compelling. The potential arrival of a global corporate giant like Visa could inject new vitality into the area. A proposed 170,000 square foot lease at One Canada Square would not only stabilize occupancy rates, but also signal to other multinational firms that Canary Wharf remains a viable hub for high-quality office space. This aligns with the broader market dynamics, where prime office assets in central London, particularly in the City and Canary Wharf, are commanding premium rents. Visa's potential relocation underscores the value of strategic location in a post-pandemic economy. Corporations are prioritizing control over physical office environments even as hybrid work models persist. This trend is evidenced by the acquisition of 100 New Bridge Street by a United States financial institution, highlighting the premium placed on prime office assets in the city. For investors, the key lies in balancing short-term risks with long-term opportunities. While Canary Wharf's vacancy rates remain elevated, the district's ongoing regeneration, spanning residential, cultural, and tech-driven developments, positions it as a magnet for future growth. The United Kingdom's new investor visa for artificial intelligence, life sciences, and clean energy could attract capital to London's prime office markets, provided the criteria align with sectoral needs. In conclusion, Visa's potential relocation to Canary Wharf is more than a corporate decision. It is a barometer of the United Kingdom's evolving financial landscape. While the district faces challenges, its strategic advantages, coupled with the government's efforts to diversify the economy, position it as a key player in London's post-Brexit recovery. For investors, the path forward lies in identifying prime assets that align with both corporate and regulatory trends, ensuring resilience in an uncertain market. Bain Capital and 11 North Partners, a retail-focused investment platform, have announced the acquisition of a portfolio of 10 open-air retail centers across Florida and South Carolina for approximately $395 million. The private transaction was executed through an exclusive partnership between Bain Capital Real Estate and 11 North, focused on acquiring and operating open-air retail centers throughout the United States and Canada. This acquisition follows the joint venture's recent purchase of 3 open-air lifestyle retail centers in Oklahoma City and reflects the platform's continued momentum in high-growth, high-conviction markets. Strategically located across the thriving Florida submarkets of Fort Lauderdale, Orlando, Tampa, and Palm Beach, as well as Charleston, South Carolina, the portfolio includes centers such as Sawgrass Square, Plantation Promenade, and Miramar Commons. Collectively, the 10 properties span more than 1 million square feet of gross leasable area, with in-place occupancy exceeding 93%. 7 of the centers are anchored by Publix, and the portfolio features a strong mix of national, regional, and daily needs tenants, including Bank of America, Chipotle, Starbucks, and McDonald's. The assets are situated in high-barrier, desirable communities known for strong household demographics, limited new retail supply, and sustained population growth. Brian Harper, founder and managing partner of 11 North, stated that the transaction represents a compelling opportunity to embed their platform in strong, in-demand communities, benefiting from significant demographic shifts across the Southeast, including lifestyle migration and an aging population. Harper expressed excitement about expanding their presence in Florida through this high-performing portfolio anchored by Publix and complemented by top-tier national retailers. Martha Kelly, managing director at Bain Capital Real Estate, emphasized that this scaled acquisition aligns with their thematic approach to investing in open-air, necessity-based retail. Kelly highlighted the excitement of continuing to build a differentiated and high-quality portfolio alongside their partners at 11 North in markets, where they have long-term conviction. The strategic joint venture between Bain Capital and 11 North was formed in April 2024, targeting open-air retail assets with a high concentration of necessity-based tenancy and long-term consumer demand drivers. This approach aligns with Bain Capital's value-added investment strategy, leveraging their global platform and significant experience across asset classes to bolster insights and sourcing capabilities. Despite inflation, high interest rates, and global volatility, Simon Property Group delivered strong second quarter 2025 results, attributing success to disciplined execution, high-quality assets, and strategic investments. Occupancy in Simon's United States malls and premium outlets reached 96%, with rising rents and tenant sales per square foot indicating robust consumer engagement, especially in affluent tourism-heavy states like Florida, California, and Texas. Simon is embracing hybrid retail models through investments in digital platforms while consolidating ownership of premium urban assets. In a commercial real estate environment still grappling with inflationary pressures, evolving consumer behavior, and global economic uncertainty, observers might expect narratives about the decline of brick-and-mortar retail. However, as uncertainty prevails, some firms are finding their footing by leaning on a combination of disciplined capital allocation, high-quality assets, and strategic growth investments. That was the news Simon Property Group's executives shared during the company's second quarter 2025 earnings call, stressing that scale, location, and operational rigor can yield durable financial results. We delivered another successful quarter, driven by the quality of our portfolio and disciplined execution, said Simon Property Group President and Chief Executive Officer David Simon. Our strategic investments and A-rated balance sheet position us for sustained long-term cash flow growth. The company's management raised its full-year 2025 guidance, setting real estate funds from operations between $12.45 and $12.65 per share. The upward revision reinforces Simon's narrative. Even amid macro turbulence, its diversified real estate platform continues to generate steady cash flow. Even as inflationary concerns and high interest rates continue to pressure household budgets, shoppers are still engaging with in-person retail, particularly in premium, well-located centers. At the property level, Simon's United States malls and premium outlets segment, which accounts for over 70% of net operating income, demonstrated renewed strength. Occupancy reached 96% as of June 30th, an increase of 40 basis points year over year. Base minimum rent per square foot climbed to $58.70, a 1.3% increase, while reported tenant sales per square foot rose to $736, suggesting continued consumer engagement with physical retail experiences. Geographically, Simon's net operating income remains concentrated in high-income, high-tourism states. Florida, California, and Texas represent the lion's share of United States contributions, positioning Simon to benefit from population migration trends, international tourism rebounds, and luxury spending resilience. In June, Simon acquired its partner's interest in the retail and parking components of Brickell City Center in Miami, consolidating full ownership of the high-profile urban asset. While terms were undisclosed, the move underscores Simon's appetite for trophy properties in gateway markets. The continued rise of e-commerce is no longer viewed as a death knell for physical retail, but as a catalyst for transformation. Simon's strategic equity stakes in digital platforms and hybrid retail operators like Rue Gilt Group and Catalyst Brands indicate a willingness to straddle both worlds. Consumers today aren't choosing between online and in-person. They want both, seamlessly. As macro uncertainties persist, the strength of Simon's second quarter may be less about beating expectations and more about restoring belief in the resilience of the American shopper. Yet despite its strong fundamentals, Simon is not insulated from structural and cyclical risks. The competitive threat of e-commerce persists, particularly in commodity retail categories. Lease renegotiations, tenant bankruptcies, and mall footfall volatility remain watchpoints, according to the company's investor call. Simon leadership also flagged global risk factors, including geopolitical instability, supply chain disruptions, and foreign currency volatility, given its exposure to Europe and Asia. Management acknowledged these headwinds but pointed to diversified income streams, Tier 1 property locations, and disciplined cost management as key buffers. Ultimately, the broader retail narrative may remain muddied by disruption and doubt, but Simon Property Group's results underscore that where consumer confidence intersects with quality, retail may be both viable and vibrant. Amazon has made a significant move in the data center landscape by acquiring hundreds of acres south of Atlanta, Georgia. This strategic purchase, finalized on July 25th, was reported by Barnesville Buzz and comes at a cost of approximately $270 million, equating to an estimated $274,111 per acre. The land, totaling 984 acres, is located in Lamar County and was acquired from High Falls 75 LLC, the developer behind the ambitious Legacy 75 Trade Center project. This acquisition marks a crucial step for Amazon Data Services, Incorporated, as it evaluates new potential locations to meet growing customer demand. An Amazon spokesperson confirmed the purchase and indicated that the site could be developed into a data hub. This aligns with the company's broader strategy to expand its infrastructure, particularly in support of cloud computing and artificial intelligence technologies. Lamar County Commission Chairman Ryron Traylor commented on the future developments, stating that Amazon's plans would be detailed in upcoming pre-construction meetings with local residents. These gatherings aim to provide transparency and address any community concerns about the impact of industrial developments on the surrounding areas. The emphasis is on minimizing disruption while maximizing the economic benefits for Lamar County. This acquisition is part of Amazon's larger investment vision in Georgia, where the company announced plans in January to invest approximately $11 billion to enhance its infrastructure capabilities. This investment is projected to create around 550 high-skilled jobs, further boosting Georgia's technology sector and positioning the state as a key player in the tech landscape. Roger Weiner, Amazon Web Services. Vice President of Economic Development, expressed enthusiasm about expanding in Georgia. He highlighted the supportive environment cultivated by state and local leaders, which enables such forward-looking investments. The planned development is expected to significantly contribute to Georgia's economic growth and technological advancement, reinforcing Amazon's commitment to the region. Population growth and favorable policy conditions are driving significant retail activity in Florida, according to a report by Sarah Daniels. Florida's major metropolitan areas are experiencing remarkably low vacancy rates, ranging from 3.1% in Miami to 4.6% in Jacksonville. This is well below historical averages, as reported by CoStar. Investment sales in these markets reached approximately $2.5 billion in the first half of 2025, with most areas except Orlando showing an increase in year-over-year sales. William Womble, an executive vice president and principal with SRS Real Estate Partners in Tampa, highlights the influx of both retail property buyers and retailers eager to establish new locations in Florida. He notes that population trends across Florida's metropolitan areas are consistently positive, attracting every major home builder in the United States to the state's suburban markets. A study by LendingTree identified 5 of the fastest-growing cities from 2021 to 2023 as being in Florida, a state known for not taxing personal income. Florida's business-friendly environment, bolstered by a new law eliminating sales tax on commercial leases, is expected to generate approximately $2.5 billion in operational savings, which could offset rising insurance premiums due to hurricane-related losses. Stephanie McCullough, a senior vice president with SRS Real Estate, mentions that while the insurance savings may not fully counteract the rising costs, retailers will still benefit. SRS Real Estate will delve into these Florida-specific issues at the upcoming ICSC at Florida conference, highlighting the state's unique retail environment. From an investment perspective, Florida's growth dynamics are driving aggressive pricing for net lease properties. Buyers in Florida are willing to pay a capitalization rate premium of 10 to 50 basis points compared to other U.S. markets. This trend is especially pronounced among 1031 exchange investors deploying proceeds from sales in other asset classes. Recently, SRS real estate professionals facilitated the sale of a Dutch Bros coffee location in suburban Orlando to a 1031 exchange buyer for $3.13 million at a sub 5% cap rate. The demand for net lease opportunities is robust, drawing investors nationwide who are interested in Florida's growth potential. Investment demand for multi-tenant properties is growing, particularly for new unanchored strip centers. Womble's team has handled sales of over 20 newly developed retail strips, totaling more than $120 million in value since the beginning of 2024. In July 2025, they facilitated the sale of Soho Round Lake, a 5-tenant strip in St. Petersburg, for $7.2 million at a 6% cap rate. There is a strong appetite for inline strips with 3 to 10 tenants, despite limited availability, resulting in multiple offers when such properties hit the market. Unanchored strip centers also attract tenant demand, according to McCullough. Shopping center owners in Florida often have an advantage when negotiating leases due to low availability of quality properties. Leasing space in a grocery-anchored center typically commands a premium, but unanchored strips offer more attractive pricing for tenants. Large-scale grocers, fitness brands, medical providers, wellness concepts, and quick-service restaurants are actively seeking expansion opportunities in Florida. McCullough notes that many retailers, especially publicly traded ones, are keen to open new locations, but face stiff competition due to high demand and low vacancy rates. Some landlords are preemptively backfilling spaces of tenants expected to vacate, creating opportunities to increase rents over previously negotiated rates. This trend offers both landlords and expanding tenants a chance to capitalize on the competitive market conditions. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoon. See you on the next one.